All right, guys, so here we are, almost at the tail end of this chapter, and now we're going to talk about adjusting entries for customer returns and allowances. So as I alluded to in the prior videos, we talked all about these adjusting entries that are being done at the end of the year as we prepare to go into the new year, right? And so as I like to say, we are creating, if this is an umbrella, which I can't really draw that well, but if this is an umbrella and I am drawing rain, right, what we're talking about is creating a safety net, because we know that it's inevitable that the customer will want a refund, and the customer will likely want to return inventory, right? And so that's what the adjusting entry is for, is bracing ourselves for refunds and bracing ourselves for return of inventory, okay? All right, so here we are talking about this. It says the sellers are required to estimate returns and allowances at the end of the accounting period and prepare two adjusting entries. So as I mentioned, one is for refunds and one is for the return of inventory. So the two entries that they're doing is, one reduces the sales account and creates a customer refund liability account. And then the second one creates an estimated returns inventory account for merchandise that is expected to be returned and reduces cost of goods sold. Now here's our example. It says, assume that the following for Net Solutions, that's who we are, we're selling things, right? Assume that the following for Net Solutions on December 31st, 2019, before any adjustments, right? So they're saying that their estimated cost of merchandise return for 2019 will be $5,000. And this could be literally based off of, prior experience or prior year's information. And then they're saying they estimate that a percentage of refunds, their percent of refunds for the 2019 sales will be 1%. So out of their 100% of their sales, they think maybe 1% of all of their sales will have refunds, okay? So that's what they're estimating. So this is all of the information that we have. So from there, we're going to create these adjusting entries. All right, so on December 31st, 2019, Net Solution makes the following two adjusting entries. So all of this is as stated before. So the first one, we're doing the estimated refunds, right? So what we expect the refunds to be. Now, it said that we expect the refunds to be 1% of our sales. So if I can jog back really quick to our sales is in the amount of $715,409, okay? And so if I go to the next slide, again, it says we expect it to be 1% of that. So our calculation to do that is what you see here. Okay, so what you see here is the $715,409 of sales times the 1% that we expect customers will be asking for a refund. And so we have a debit to sales and a credit to customer refunds payable, right? So if I had to do a T account again, my customer refund payable account, debit, credit. Right, here is where we're setting up our safety net, right? And then in the new year, in 2020 somewhere, right, that's when we'll have like a $900 refund or $800 refund, right? Because we've already set this up here, okay? And also, if you're looking at this, sales is rarely, very rarely ever a debit, right? We know that sales is normally a credit, right? So this is showing that you're reducing sales to accommodate for those refunds to come in the future. And then our next one we're talking about is debits. Our adjusting entry is it debits the estimated return inventory, and it reduces our cost of goods sold or anything that we expect to be returned. Now, in this particular instance, there is no calculation to be done because in a prior slide, it told us that our estimated return that we think we will have is $5,000. So with that, we're just going to go with it. We're going to do a debit to estimated returns inventory, and our credit is to the cost of goods sold. Okay. So lastly, what I want to make sure I show you guys is this table, which you can also find in your book. But this table is a really good indication or a really good snapshot of what you should be looking at if there's a refund, or if it's just a refund, or is it a refund plus a return of inventory. Now, in our first one, it says this is when the customer does not return inventory. And so if the customer does not return inventory, meaning they keep it because it's maybe too much to ship, so forth and so on, then usually they'll ask for either a cash refund, or you can reduce their receivable. One comes down to being a one-time customer. So as we mentioned in prior videos, maybe this is a transactional customer, and then this one is one that is an ongoing customer, right? So that's only if we're returning, they're not returning it. But if the customer decides to return the merchandise and want a refund, then if it's a cash refund, it looks like this, right? So it mimics what we've seen up here, but they're getting their cash refund and they're also returning the inventory. Now, if again, we have an ongoing customer, it looks like this, what we have captured up here, but they're also returning the inventory. So again, a good snapshot. As you read through the problem, you're asking yourself, hey, are they just getting a refund, or are they also returning the merchandise as well? Okay. All right, so with that, we're going to stop and we're going to talk next all about